Welcome to Module 4 of Week 3. And this covers the AGE and deductions, which is probably the easiest part of the course. In fact, I find people very rarely get this wrong. And it's also the easiest part of probably doing the tax return. And again, very few people get it wrong. And we're going to look at some deductions to gross estate. And similar to our income tax return, which has a above-the-line deductions, which we call adjustments, and below-the-line deductions, which we call itemized deductions. We have a similar type of thing when we're dealing with gross estate. Although they're all deductions, above-the-line deductions are called adjustments. And although that's not found in the tax form, it is needed in order to do many of the calculations that are used for saving taxes and deferring taxes that we'll be covering later in the course. So it's important to figure out what are adjustments of the deductions and which ones are not adjustments of the deductions. So we're going to have to watch ourselves on the deductions. You have to be careful when you read it. It talks about the adjustments to gross estate. These are things such as mortgages, liens, and debts. In other words, money owed by the estate at death. And again, remember, we're on an accrual basis, not on a cash basis. Funeral and administrative expense, and casualty and theft losses. These make up the majority of it. If you had income in respect to the decedent included in gross estate, that would be an adjustment out here because it's going to be taxed to the tax return of the estate or the beneficiaries. But as a general rule, these are the ones you're going to see: mortgages, liens, and debts, funeral administrative expense, casualty, and theft. Now, the casualty is the one you have to be careful for. It's the casualty during the period of estate administration. So the typical example is there's a car crash, and in a car crash, the driver dies and the driver owns the car. Well, at the time of death, the car was not worth anything, so it doesn't go into the estate. But we'll take another example. Person owns a car, lends it at death, the son gets to use the car, and he crashes it and totals it. We now have a deduction from the estate because at the date of death, that car should be included in the estate, and then after that it came out. So that is probably the more difficult ones. I think we all understand theft. Administrative expenses are a lot higher than you probably would expect because you have the probate court cost, you have lawyer fees, you have accountant fees, you have taxation fees, you have property management, you have insurance payments you have to pay. You may have to bring in financial advisors. You're going to also have people who have to show up for the reading of the will, etc. So the administrative expenses tend to be very high compared to what most people expect to see. Deductions, which are the straight deductions that are not going to be used for purposes of calculating the various tax savings that we'll talk about later in the course, are meritable deduction, charitable, and state death taxes. Now let's go through each of them separately for a minute. The marital deduction has to be either a full dominion and control given to the spouse, or it has to be a qualified under the tax law exception that allows it to be deducted. So if I give my wife something and I put some kind of restraint on it, it must be a qualified restraint called out in the IRS code. And we'll be going over that in week 4. And likewise in charitable, it's the same thing. I can give full dominion control to the charity, no problem. But if I put some kind of constraint on it, it's got to be a qualified constraint. And we will cover that later in the course when we cover charities. The third item is the state death taxes. Now this depends on the year of death. Sometimes it's a credit to the estate tax. Sometimes it has no value at all. Sometimes it's a deduction. So you have to look in the year of death to see how the state death taxes are used and what can be used. because sometimes the government has a formula as to what to be used, sometimes it doesn't. So it's a generic, we say state death taxes, including estate and inheritance deduction, but it's the year that's important of death. That determines what we're going to have to pay. Non-citizen beneficiaries. I think we all understand that if you're a citizen of the United States, you're subject to all of our laws and benefits also. But if you're not a citizen, we have special laws in the state, and these are for non-citizens who are residents of the United States. The marital deduction does not apply to non-citizen surviving spouses. So it doesn't matter if you're a citizen of the United States or not when you're the decedent. What's important is the surviving spouse is a citizen or not. Let's see who gets if the marital deduction applies. And having filled out many estate tax returns, I learned the hard way that I always have to have proof of the citizenship of the spouse. They'll tell me they're a citizen. It may not be true. So I say, well, give me a birth certificate or a passport or something to show where you were born. And I generally include that in with the estate tax return, along with the other tons of paperwork that has to go in. A QDOT, which is Qualified Domestic Order Trust, however, can allow for non-citizen spouses to obtain a deduction. It is administratively complex. However, if we're talking about a substantial amount of money, it's worth it, obviously. And what it does, it basically says that wherever the surviving spouse goes in the world, they're still going to be subject to taxation. And the way they control it is by having the trustee being an American citizen who the government has control over. Credit for taxation at the beneficiary's death. Now, let's go through these probably very slowly. If property of the decedent has been subject to estate tax within 10 years before or 2 years after death, tax credits are available, but they're limited to the smaller of, first of all, the amount of the federal estate tax attributed to the transferred property in the transfer's estate, or the amount of federal estate tax attributable to the transferred property in the decedent's estate. This probably isn't going to come up in the CFP exam. However, this is something you need to doc with your clients, because it is very common that when a married couple and the wife dies first, the husband dies within 2 years. And if the wife left assets to the husband and 2 years later he had the same assets, he can reduce drastically his estate tax. So, or it could be where the husband dies first and then the wife, but usually she lives 30 years after. So I think that typically you're going to see the situations when the wife dies first. Gifts added to the gross estate. Gift taxes paid on gifts added back to the estate are credited against the tentative estate tax. What that means is we have the gift tax paid on gifts that had gone back in the estate under the 3-year rule. Those gifts are credited against the estate tax, and we'll show that how that's done when we go through the calculation of the estate tax. That sums up a short session, but important session, because it covers the easy part. And I guess the easy part is, I find few students make errors in this part, which is why I call it the easy part. And also it's the easier part from the tax standpoint. We don't have to do the amount of research or anything.